Now, gentlemen, a couple of things. We had an evangelical type experience early in the afternoon, then Vimal came on. Felt like I'd been to a party, had a hangover on about 3 hours. But now, so we want a nice level, calm, post-party day here. We want some intellectual stuff, but don't make it too dour for the rest of us because we're trying to recover. Now, there's also a lot of pressure on. With the panel here, which is the stock market panel, in the last 2 years have given us a stock tip, and they'll do the same this year. So thanks for bringing along the stock. We'll ask that at the end. Everyone can write them down. You can keep your own watch on them. You can put a tick or a cross against the name next year when you come along. But the last 2 years, they're under a lot of pressure. The last 2 years, the participants have shot the lights out. So in 2015, the average return for the three panel members was 27.4%. Happy to declare Ben Griffiths the winner of that panel with a 35.5% return on Auckland Airport. Benny, well done.
Yes.
2016, they took it to another level. Total return on average 36.5% for the three stocks. Benny let the team down. You went from top to bottom in one fell swoop. You picked Aventus and it gave you 7.4%. But you also said you're very negative aged care stocks in Australia.
I did.
And that came to light virtually within 24, 48 hours. Where stocks started to tumble. They must have been listening in, investors. The big winner last year was Crispin Murray, who picked Qantas, and I asked him what, long or short? And he said exactly the reason why. It's long, and I think it's going up. He clocked up a 70.5% share price return. So terrific stuff.
And he didn't come back this year?
No, he doesn't get him. Once we thought bring the winner back, but they go straight to the bottom the next year. So we trialled you with that.
It's true.
So if you finished last, you're a chance of getting back on the panel.
Got it.
So that's how you got your invitation. Right, we've got three different investors here, all concentrating on the Australian market. We've got Martin, who runs a big portfolio, big caps. We've got Steve, who is known everywhere as a great value investor, both onshore and offshore, ferrets around the very small end and the bigger end. And Ben Griffiths, a veteran and a legend in the small cap market. So we're going to get three different views. Martin, I'll kick off with you. Everyone out there, blank piece of paper, where do you start and how do you put a portfolio together? Maybe just tell us a little bit about your technique and how you go about it with such a large amount of money.
I think people always worry a lot about the amount of money, and I think people inherently are always very attracted to small. And really, to us, you look at the long run in Australia, actually there have been as many winners in big caps as there have in small caps. Really, small gives you more amplitude. If you've had a portfolio full of the major banks for the last 25 years, you've probably beaten just about everyone, big or small. So we take the approach of saying, well, we look at big, small, everything in Australia, but we stick to Australia, and we have a reasonable number of people. So we have, a dozen or so analysts. So generally our approach is we try and know everything well, and we try and work out what we think we'd pay for the business. That's where we start. Then we're just sitting there saying, compare that to the share prices. And probably my humble opinion, specialists in the long run. So if you look at global investors who've tried to specialise in the whole world in active management have struggled in the long run. The guys who've stayed narrow, specialised in a reasonably narrow area tend to have much better track records. That's generally the approach we have.
And you put together 50 or 60 stocks in your main portfolio, and it's all about relative returns rather than and trying to differentiate between asset classes. You stay invested?
I think, we look right across, we go down to micro caps as well. So we look at everything, and we've got a couple of main funds, both of which are very broad caps. So we don't say, there's no magic line which says suddenly stocks get really efficient at number 21 or number 51. That's an absolute nonsense in our view, that everything in Australia is pretty well covered, and it's not like the inefficiency in the market is always in small caps, always in micro, or always in large. It will vary over time, and where you make money will vary over time. So we try and keep the universe pretty broad in all those products, but we also keep pretty diversified on that issue of relative versus absolute return. In the long run, they're pretty much the same thing. We're all trying to make money. All you're doing is saying, how do you measure risk versus a benchmark or absolute?
Okay. Steve, you've put together a portfolio a couple of times in the last 8 years, and you've got an approach about it, and you think there's a certain bandwidth with the people you've got working with you. You want to just run us through how you go about with the blank slate and kick off?
Yeah, we did a pretty horrible job the first time around, so that was a good lesson. The first 2 years of our Australian fund were fairly horrendous, and it was that cash burning a hole in your pocket. And I think for anyone in the room who's starting a portfolio new from cash, I think that patience around putting a portfolio together is really important. And I think for us, when we started our international fund 4 years ago, we took that a lot more carefully. And it wasn't sitting on cash, but it was starting with a portfolio of high quality blue chip businesses that we thought were trading at reasonable prices. And then we moved to some of that more high conviction stuff at the smaller end of the spectrum, perhaps riskier, but where we'd taken a lot of time to get to know the stock, put a lot of work into it. We've migrated more towards that over time. So I think patience when you start out is really important. For us, we're a small team and we want to restrict our amount of funds under management. I do think there are times when there's really good value at the big end of the market. It tends to be during times of general market distress. You know, we've made a lot of excess returns over the past 4 years in a period where markets weren't that cheap to start with. You know, there was that variability within the market that's allowed us to do that. So for us, a small team of people, because we only want to manage a small amount of money, and I have a view that about 10 stocks per person is the right sort of number. So if I was just running my own portfolio, I'd probably be running a 10-stock portfolio. We add people to the team. We add expertise in different areas. I actually think that was a really, really good point. People say to us, how do you cover the world? We don't. What we want is 4 or 5 people that are experts in their particular market, and I will put a fund together that combines their ideas.
You're telling me my 60 stocks is far too much. So no wonder I don't feel comfortable with all of them.
It depends what you want. I think with 60 stocks, you're going to end up, you know, market plus or minus something over a decent period of time. If you want a lot more than that, then you probably need to run a more concentrated portfolio. Okay,
Ben, you've done it a few times. You've started there with a blank slate. How do you go about and what do you look for in stocks?
Well, I'd like to pick up on a couple of points that both Steve and Martin have touched on. The first thing is the importance of process. You need to have a proper process that contemplates quantitative factors. In our case, we use a GARP style of approach when we do valuation work, growth at a reasonable price, looking at a price-earnings ratio and looking at the next 3 years' forecast earnings per share growth. And we need a process that contemplates qualitative factors. They're essentially management, our view of a company's management team and its vision and its principles and its concepts on managing capital, and of course the quality of the industry that a company operates in. So you need a process that'll bring together a ranking system to the point that the guys have made. There are an enormous universe of stocks we've got to cover. You can't cover all the ground. So you need a process that quickly enables you to cut to the important elements, and that is you need to be able to tease out where value lies. And upon getting a process in place, you then need to make sure that you are going to have conviction around that selection process. We have an optimal range of 35 to 55 stocks. We've heard Steve having some fun with Matthew there. Matthew likes to have 60 stocks or so in his portfolio. We don't go beyond 55 stocks. We go 35 to 55. 35 is as concentrated as the portfolio should be. And we think diversification is captured by about 55 stocks. We want to avoid, and I guess all of you in the room as investors in managed funds perhaps, you need to find managers that aren't stock collectors. You need to locate managers that are, you know, that basically are high conviction investors who actually use their process and back themselves into stocks or sectoral calls. So we have an experienced team. We use a process not dissimilar to how Martin operates. And we cover the ground. We cover probably 400 stocks in our investable universe. We apply those principles, and at various times we'll look at the tactical aspects. How much cash should we have as we go through the market cycle? And to Steve's point, you can go into some pretty tough old markets when you want to have a big cash buffer there, despite the fact that you're seeing value. You need to get through a difficult market. So we're process driven. We've got a good team, and we use our nose to navigate market turns.
All right. Now, the title of our discussion today is Avoiding Bombs. So it doesn't matter how good the process is, bombs appear everywhere, and it's just part of the game. But the question is, how do you handle these bad calls or what seems to be a bad call in the short term? The bombs, as we've called it here. Martin, I know we had a discussion last week and you were explaining for a couple of years you made a big call on resources, went overweight in the fund and it hurt for a while. And you made the terrific quote around holding your ground for 6 months is relatively easy. Holding the line for 2 years is very bloody hard. Do you want to explain going through that? And obviously we've come out the other end in the last 18 months. It's been a terrific call. So it worked in the end. But those couple of years, like everyone's sitting on losses, everyone's feeling a bit of pain at different times.
Yeah, emotions, I think, for all of us, an incredibly tough thing in investing. You think it's nice to feel smart, but the pressure always mounts. It's like success has 1,000 fathers, and when you're wrong, most of your clients are going to tell you you're stupid, and when you're right, they'll think you're a genius and listen to you. They're the facts of life. Part of the reason, I think, as Ben said, that's really when you need process, and you've got to go back to saying, okay, what did we get wrong here? And go back to the basics of saying, did this business change in value, or is it just the share price that's changed? And that is always the discipline, whether it's a winner or a loser. You'd say, okay, well, people in our business often think in share price terms rather than, and we always think the best discipline is to say, if this was all my money, think about it as though I'm buying the whole business. And that gives you a very different mentality. So the questions we were asking in resources is, why do people hate them and why are they buggered forever? And when you sit there and think, if I'm buying a really low cost iron ore mine in WA that no one can produce iron ore cheaper than I can, and it's not making much money, but I can't see that people are going to stop using steel in the world anytime in the next 50 or 100 years. You sit there and think, all you know is, like most things in the world, it's a cycle. And you've got to have, just like 2007, everyone thought that it was going to be forever. They were wrong on that side. The same thing was true on the downside. So all we do is sit there and think, you go back to the research, you look at all of try and put things in long-term perspective and long periods of history, and work out, if you like, what you think a business is worth.
If you're carrying a trade or a position that's not working, do you think it's the process that's wrong, or the inputs, or the decision making? What do you normally find is wrong, and you can find, you can get to the nub and try and correct it?
Investment's pretty simple. We're basically buying streams of earnings, and companies choose to put an amount of debt against it. So they change your risk by putting financial leverage. And the multiples are the emotion around that the stock market has in any particular time. They're the only things moving stocks. And you sit there and think, okay, which of those things have changed? Usually when stocks are going up a lot, most of it is the emotion. It's the multiple changing. Sometimes it's obviously the underlying earnings, and a lot of times it's the fact that debt blew you up. Unfortunately, we've been in a long period of history now where debt hasn't ever blown you up, with a small period of exception in the global financial crisis. But mostly, the last 25 years have been about big gear to the bejesus.
Yep. Steve, you specialise in ferreting around, foraging, in rubbish bins, finding the butt of the cigarette, having a puff. That's a dangerous game for a lot of people. Things can go wrong. Stocks can go to zero. They're not protected, or most of them are. So maybe you can share with us what you think when things go wrong. How do you handle it, and what are the indicators, and what activity do you take to correct it?
And look, a minus 100 is not unheard of in our portfolio. We had one in the last year, and the overall portfolio was up 27% in our Australian fund, and that was with a minus 100. So we think about portfolio allocation a lot when it comes to the risk piece. And I think to Martin's point, we deal with a lot of, we're buying things generally that are falling and that people are pessimistic about. They often fall further. The challenge is, okay, if nothing has changed with the business, that's a really easy decision. We're going to stick with this. The challenge is when the business has deteriorated, but the share price has also fallen, and you've got to sit there and make this decision about, well, has the share price fallen more than is justified by the business, or have I actually got this one wrong and I've got to get out? And I think it's really important to be prepared to cut those ideas where the idea is not right. And if you turn around, I normally wake up the next day or the next week if I can get out of a stock. Some of our stuff's pretty illiquid, but in the more liquid stocks, if you sell it and you wake up the next day and you think I've done the wrong thing, then you probably have done the wrong thing selling it. If you wake up the next day and you say I don't want to buy this anymore, then you've made the right decision by getting out of it, because we tend to hang on too long when the investment case is not going right. Look, for us, we talked a little bit about diversification earlier. We think a lot about risk correlation rather than how many stocks we own as diversification. So do we have too much exposure here to any one factor that might bring us unstuck? Whether that's interest rates going up, whether it's deflation, whether it's a recession in Australia, there's lots of things that can go wrong, and we can't really avoid all of them, but what we can do is make sure we don't have too much of our portfolio in any one of those ideas. So, bottom of the resources thing last year, we lucked into buying Whitehaven Coal at the absolute bottom, but we put 1% of our portfolio into it, and we run a 20 portfolio stock. So normal portfolio allocation for us is around that 5% level. 1% was the maximum limit that we wanted to do there. In hindsight, more would have been great, but from a risk management perspective, it was a stock that clearly, if coal prices stayed really low for a long period of time, the balance sheet was going to bring it unstuck. So we said, okay, 1%'s enough here. We may lose 1% in the portfolio, but we may also make 10 times our money. Yeah. Unfortunately, we sold it after making 2, and we could have made 10 times our money.
It's a really interesting point, because I think you mentioned Qantas going up a lot. One of the main reasons for that is oil's gone down a lot.
Yep.
Every airline in the world's made a lot more money as oil's gone down, and some of those things you never think about the correlations, but sometimes you think there's a bit of luck involved.
Yeah, so an oil producer and a Qantas in your portfolio, that's diversification against that particular risk, and it's something that you should be thinking about all the time.
Matthew, but mate, the blow-ups, basket cases, implosions, they are occupational hazards of this business, right? When you're a portfolio manager, you go into battle every morning, and you're anxious about the portfolio of 55 names you've got. And sometimes you walk into some rippers where they do turn on you, and you've got to act quickly. We had 2 in the last 2 or so years, 3 years, and Slater and Gordon and vocational training, 2 stocks that it's amazing how you can be on top of a story. In the case of Slater and Gordon, you can be passionate supporters and believers in management and buy into the roll-up concept, but at some point you start to challenge what's actually happening there. And then when something goes wrong, really wrong, and there was a major system failure with Slater and Gordon, as many in this room will recall, you need to act. And that was one of our biggest active positions in the portfolio. We thought the underlying fundamentals of the business generally weren't too bad, but something was starting to come horribly undone within that business, and we need to move. It's just you need to be. Larry Williams is a fantastic technical trader that I follow out of the US, and he said, as a fund manager, if you get one thing right as you go through your career, it's learn to be a slow buyer and a fast seller. If you can master that, you will be well down the way of being a successful manager of money. And that's not easy to do, because when a stock's moved against you on the downside, it's through your purchase price and starting to hurt you. You are instinctively wanting to will the stock back up and hoping I'll buy some more when it gets cheaper. There comes a time when you've got to act.
There's a second element to all this, which is you're driving your tank to work, ready for the battle, as you called it, every day.
Yep.
The first decision is something's gone against me, let's cut the position. The second position is you've got to front up to various clients and your own people in the office. And so how hard is that? I mean, the rest of us have only got to answer to ourselves, but when you're managing money for other people, there's a lot of voices in the room at different times.
Totally. I mean, it goes to the saying that I quite liked, and that is that funds management is a marathon conducted in a series of 100-metre sprints, and that's what it is. We are accountable monthly and quarterly. We need to be well versed in where we got it right, and we need to be equally as well versed in where we got it wrong and why our conviction is still right if we're persevering with a poor position. Or in the case of, we owned Domino's Pizzas for a long time, and there wasn't a meeting with a client or a consultant where I didn't have to defend holding a stock that I'd paid $12 for, which was currently $45 and trading on 48 times. Why do you still own that? And it was a bit of a battle to explain it. I could explain the fundamentals, which were strong earnings per share growth underlying the share price. But I really got away with explaining it to the clients and the consultants by saying, this is a stock market that's starved of growth. This is a market globally. Stock markets are paying up. They're paying full prices for deliverable growth, believable and achievable growth. Domino's fitted the bill at the time. That stock went to $80, by the way, from $12. And there wasn't a quarterly catch-up that I didn't have to explain myself. And I knew the pressure was really on, because I didn't want to have to explain it when it was back down at $30 if it was to get there. So we very carefully exited that stock and sold the last of our stock at around $70. But that's an example. You are continually accountable. But that, again, managing external monies, being live in the market, that's part of the game.
All right, well, let's just a little bit of a derivative of that, and we've talked about a bit, is emotions. We heard the guys earlier this afternoon talking about themes. They were very emotional things, world-changing stuff. Martin, maybe you can talk about, you're sitting there every day, you're counting every dollar of the 10 billion, and you think, well, how do I handle this? Can I afford to rant and rave, or can I, be overjoyed? Just talk about emotions and how you feel every day, because it's a hard job in that sense.
Yeah, it's funny how everyone, and because I always reckon my job's to be unemotional about things, in that our job's to compare all the investment opportunities that are out there, not to get emotional and passionate about things, because we're all passionate about our jobs. We want to do the best job we can. We all might have a slightly different way of skinning the cat, but the principle to me of saying our job's to value businesses, a lot of the chasing momentum, getting on and technology and things like that is a great example at the moment, isn't it? It's like people are pretty emotional about it. They think it's going to take over the world, disruption, all of those things. It's easy to get emotional about. That has a massive impact on stock prices, and that's obvious.
And does it help you avoid the bombs, getting back to the theme of the discussion?
I think, as Steve's pointing out, different investors are different. We tend to be better at that. We tend to make a lot of money at inflection points when things are tough. We tend to do not very well when there's a lot of froth and bubble. That's the nature of how we are. We're more contrarian than we are momentum. That's the principle of when I say being unemotional, what we do is try not to get caught up in stock prices and emotions getting carried away and people paying silly prices for things, because they will defend it. There's always a bubble going on anywhere and everywhere in something. Yep. And people will be rationalising it. That's how bubbles happen. And my job, as I see it, is to try and over time avoiding the landmines is at least as important as picking the winners.
Okay, Steve, you're a country boy. Farmers and fund managers are the same. It's always hard. It's never a good time. Does that help you growing up in the country? You're about as cold as anyone I've ever met. You're ice in your veins.
Thanks, mate.
Nice guy, but emotions, how do they affect you?
Funds management's a much better business than farming, I can tell you that. Okay. It may be similar in terms of cycles, but the returns across the cycle are a lot better. Look, I spend a lot of time thinking about this, and one of the things that's really important is that these psychological biases, they work at a subconscious level. So you sit there and you think, I've read Daniel Kahneman and I understand all this stuff that he's talking about, and now I'm not going to make those mistakes. And then you still make the same mistakes. Yeah, I loved it. I thought it was great. You read it all, you understand it, and then you wake up the next day and you say, I still made the same mistake. And it's really powerful at a subconscious level. One thing that I think is super important to help you deal with a lot of these things is think of your portfolio in percentages rather than in dollars. So we sit there and we think about a stock and we say, is this stock a buy or is it a sell? Do I want to buy it? Do I want to sell it? Instead of thinking like that, if you think about your portfolio and say, what's the right weighting for this particular stock? Okay, this thing's got a lot riskier than I thought it was. It was a 6% weighting. I now think it should be a 3. I may still think it's a good stock and a good buy, but you should be selling it to get that weighting right. And I find it easier to be rational about percentages of my portfolio than about individual decisions about when you buy or when you sell. And that makes the dollars that you're running irrelevant. Whether you're running 20 million or 150 or 2 billion, you're sitting there thinking, what's the right weighting for me towards this stock? And I think that helps me put a lot of those, is it a buy or a sell, or is it getting away from me, or what's happening with the price? It gets a lot away from a lot of those things.
Okay, Benny, you're an aspirational farmer.
True.
And you look at emotions like you've had to, as you've told me before on many occasions, you've had to train yourself not to be emotional.
Absolutely.
So how's that training going, and is it helping?
Well, I was about to start off by saying that removing the emotion from being an investor is a lifetime's work. I'm a fair way through that process, I like to think. But it is absolutely a crucial part of your stock in trade as investors is removing that emotion. And that's emotion, that's gut-wrenching emotion when something moves against you and you've got a bigger position than you might be comfortable owning, or you might even have a little bit of leverage against it. That really makes your gut churn. But you need to remove emotion, and that anxiety that goes with the spot positions going against you in a much reduced form exists when you're on a stock that's doubled for you. And you think, how fantastic is this? I might just take that profit. You've got to ask yourself, actually, is that the right thing to do? Is stepping off now, you've doubled your money, you've got this thing in your mind about doubling your money, you've done that. Is that the right thing to do? And more often than not, in a trending market, in the right stock, that's not the right thing to do. You need to hold and go with it. And that's just as challenging to stay on a winning stock where you're in profit, right? And you really want to, the whole idea of buying a stock is you're looking to optimise your entry and your exit point. You want to maximise your return on it. That will involve not getting off too early. That's just as emotionally challenging as having one that's gone against you and you've had to wrestle with the idea of selling it early. So I'm still training myself to remove emotion from the decision. I'm happy to say my team of 4 investment professionals, as you guys much younger than I, have also worked pretty hard at that. And we are just, to Steve's point, we try and look at stocks in terms of percentages of the portfolio. It's a stock code and a percentage. I think it's going down. That meeting was terrible. The numbers don't look good. We've got to get out of it. Think about where it's going, not where it's come from, is a big motivation. But you need to remove emotion. It's first and foremost.
All right, let's get on to the exciting stuff.
Right.
Today's markets.
Yep.
Consensus view, probably overvalued or fully valued. You want to lead off with a discussion around where we think Australian market is and on the back of that global equity markets.
Yep. All right. I often run bullish, not always. As a house, we were bearish going into 2007 and we stayed cashed up through 2008 GFC, as we'll all popularly remember it. We're bullish. We're bullish as a house. I quite like equities where they are right now. I'm not so afraid. Matthew makes a point. Equities aren't as cheap as they were. Sure, they're on the other side of fair value. Let's look at equities in the first instance as a tactical allocator would look at equities. A portfolio manager sitting in a large institution, like Schroders, would sit there and he looks at his equity decision versus bonds. Are equities a better investment than bonds? I run equity risk premium work every quarter to do my backdrop, my fundamental analysis on are equities overpriced? Are they cheap? Equities, the equity risk premium for the US stock market's 5%. For the Australian share market, it's closer to 6%. That's suggesting the return on equities reinforces the case for equities versus bonds. Bonds or equities are a better bet right now where they're trading, both here and internationally, versus bonds. So we're equity bulls in terms of the equity risk premium. Most stock markets peak or have peaked historically when the equity risk premium has got to around 2.5%. Today, as I mentioned, it's 5 and 6% in the Australian market. So I take fundamental comfort from the fact that the setting versus bonds is very appropriate. And I also like the fact that the bond curve, the yield curve in the United States is still positive and steep. It's not as steep as it was, but it's still positive. That's a constructive setting for equity markets. And I recall from the last time markets legged down, the yield curve inverted about 12 to 18 months ahead of the equity market selling off. So we're no closer to an equity or a bond curve inversion from what I can see. So I think the backdrop, both in terms of equity risk premiums and yield curves, is fine. And I must say, Matthew, this rally we've had on Wall Street, which for me has been quite orderly, with the exception of the NASDAQ 100 has had some blow-off moments. Generally speaking, the advance on US equities has been quite orderly in terms of price and time. It's been the most loathed equity market rally I can recall. And the AFR last week ran a story. The headline was, Wall Street's latest game is guessing where the market peak will be. For as long as there's that sort of discussion going on, and for as long as you've got bears out there trying to pick when the turning point will be, I think the market has further to run. Just on their local market, our market, the ASX 200, can't get through 6,000. It can't do it. 6,000 has stopped the Australian equity market advance for over 9 years. When the 6,000 level gets cleared, we're away. The Australian share market will go. And we are kind of unique down here. We are one of the few markets, Western markets, major markets of the world, that is not at an all-time high or not even close to an all-time high. We are such a terrible laggard down here. So we clear 6,000. I feel the rally would be pretty aggressive and we'd run back through to our old highs of around 6,800. So we need to clear 6,000, Matthew, and that's been a challenge for 9 years. So I am bullish. I'm bullish on big caps and I'm very comfortable in small caps.
There you go, Martin. Benny, the small cap experts throwing out the challenge to the bigger cap or the more broader market. Are you as bullish or are you a bit more circumspect? And if you are, where should we be circumspect? Because this comes back to the bombs. We don't want to be in bombs.
Yeah, it is a bit of a strange environment because, as Ben's sort of alluding to, that you feel like most investors are being dragged kicking and screaming into it. No one's really bullish, and I think that comes from, as we were touching on earlier, the artificiality of the world. When central banks are buying bonds, equities, their balance sheets, there's a lot of stuff being bought with printed money. Investors effectively sit there and think this all feels a bit artificial, and there's no doubt there's too much intervention, but there's not the euphoria that would normally be attached to extremely effervescent and wildly overvalued markets. So that investors being dragged kicking and screaming into it, I think, gives you a bit of discomfort. That said, well, gives you a bit of comfort that things probably aren't crazy, and the reality is all assets in the world are overvalued. I don't think there's a great argument that equities look really expensive versus everything else because pretty much everything's gone up together.
And what about those areas of the equity market you'd be more worried about?
We tend to believe, if anything, that big caps are more undervalued than small. And I'd almost look at it and think, if BHP broke itself up into South 32, 3, 4, 5, 6 and 7, do you reckon they'd go up or down? And I reckon, like South 32, there's more appetite for the smaller things and the conglomerates and things like that. I guarantee that for the most part, if you broke them up and turned them into smaller companies, most of them would go up. Yep. Mm-hmm. And that, I think, is symptomatic of saying a lot of passive money's driven into the big end of town. A lot of people are indexing that end of the market. More and more people are shifting down to the smaller end to find their risk. Generally, that means, if you like, the opportunities in a lot of senses are going to be left behind in the bigger end.
And what about the famous bond proxies with the bond market the way it is in the equity market, being property trusts, infrastructure, to a lesser extent healthcare, those things? Do you worry about them?
I think it goes a little bit to what Steve was talking about before. The danger really is they're all correlated in that they're going to get moved by the same thing. And the difficulty there is that lack of diversification, if you'd had it for the last 20 years, would have worked massively in your favour. As bond rates have come down, down and down and down, the question is, they're so close to zero now that, to me, the tailwinds have largely gone, and that therefore we'd look at it and think there is absolutely no way they can replicate their past returns, and on balance we'd say there are better opportunities elsewhere.
Just on the resources, which we've talked about a bit earlier, still think it's value there?
Yeah, for the most part, we still think that's probably where the best value is in the market, and why. We've had a whole lot of cycles, so people know there's a cycle and there's nothing. If you look at the financial cycle, we've been increasing debt and increasing financial leverage and so on for 25, 30 years now. These are very long cycles. Resources underneath that are going up and down all the time, and we had a bubble in 2007 and then it blew off and we had the reverse side of it. In terms of where we are, price to books, all of those measures would tell you there's no way these things are expensive versus history. You're still buying the best quality resource companies at 1.5, 2 times book value versus history. There is no way that's super expensive.
Okay, Steve, you as said, forage around a slightly different end of the market most of the time. Equities in Australia, and you can even mention globally, lots of opportunities or overvalued in general. How do you feel?
I don't think equities are expensive here, and just a little bit to Ben's point. We started our Aussie fund in October 2009, and the return, including dividends, since October 2009 has been 7.5% from owning the whole Australian market. That's not rampant bull market returns, and I think assuming there's two ways that equity premium can close. One is interest rates and bond yields go up, or equity prices go up even further, that brings it down. And I think the bond yields going up is probably more likely. But when you're comparing indexes, it is important to think about dividends, because we have a fully franked dividend regime here, and people pay out higher dividends than they do in the rest of the world. So the US index should go up every year because they don't pay much of it out. The Aussie index pays out a lot of income. And I think if you look at the accumulation index, it's not as bad. The struggle for us, and the big struggle for us, is that I feel like the playing field has levelled out. We were enjoying ourselves in a similar part of the market to Martin a couple of years ago. Those resources stocks were really bombed out. You know, we were venturing into the large cap end of the world because stocks like South 32, which probably became small cap at some point because the share price was down so far. You know, we were finding those pockets of extreme distress, and I don't see those in this market. I think the overall market's not stupidly cheap, but there's not a lot of volatility like Vimo was talking about, and that makes it hard for people like us that are very concentrated, looking for pockets of distress, to find those pockets of distress. And my big mistake leading up to 2007 was, okay, we're not finding the right sort of businesses at the right prices. This stock looks like it might be cheap, but it's lower quality, and I think that's really dangerous in this sort of market. I would actually rather own big, stable businesses that are reasonably priced than be buying small cap stocks that appear cheap, that are low quality businesses, because when the cycle turns, those stocks get hit a lot harder.
Yep, and the liquidity just disappears, as we know. All right, time has arrived. We are going to take questions in about 3 minutes, but the time's arrived for stock selection. Ben, since you're the veteran of the panel,
Yes.
I'm happy for you to give more than one stock, but you'll have to land on one for next year's panel and how we rate you. So
I've got one. I have one already. I have one.
one, but you can tell us more. We're happy to hear more stocks, but you'll have to land on one that you like, which I know you got, so far away.
Platinum Asset Management is the stock I'm going to nominate. Do I get to, I've got 25 words or less, so I can
Yep,
do my
exactly.
pitch.
Yep.
Platinum, as we speak, ladies and gentlemen, is 10% short in the market. Platinum has been somewhat beset by some operating issues, shall we say. Their performance had been not as good as it had been in previous years. Platinum have had the challenges on the performance side. They've endured outflows. They've had some staff disruptions. Some of the portfolio managers have taken off. So there's been a little bit of turbulence in terms of staffing. The competition has certainly lifted for those guys. Magellan have built a business right under their nose. And finally, consultants, the risk of a consultant downgrade has been looming large. We're beginning to think that a lot of those variables that have impacted on the fortunes of Platinum Asset Management, in fact, have stabilised and in many cases improved. Performance has turned. Outflows haven't yet turned, but they're a lagging indicator or a lag. They tend to lag performance figures. The staff situation seems to have stabilised. The consultants seem to like what they're hearing. We believe that if those variables can turn sustainably, then there'll be an earnings kicker for Platinum. Performance fees will be back on. The performance is already quite impressive for the 1 year. They're up 21% versus 15% in their flagship fund. So performance has turned. That means performance fees possibly at some point. The big short position in Platinum, which is the biggest on record, means any good news, I think that stock will spike higher. It's a well-managed business. We like what they're doing, having been through a rough patch. Platinum Asset Management for me.
Okay, thanks. Martin?
That was 25 words, was it, Ben?
2,500.
Well, I think it was closer to 2,500, but that's okay. It was all valuable. It was valuable.
Thank you, mate.
Martin, can you give us a stock? It can be long, short, far away.
Yeah, I'll cheat and have a couple, but at the small end, we like things like 3PL, which is a business that owns Mathletics and Reading Eggs here. It's a really interesting business because it's got a whole lot of customers, sells to primary schools and so on around the country, and was floated, did badly and fell to 50 cents. It's back at sort of $1 or so now, but we think it's got the makings of a really interesting business in technology, which is an area of froth and bubble, but it's a long way from froth and bubble in terms of its valuation, and it's got a lot of prospects, etc. At the larger end, as I said, we still like resources, things like alumina. When we look at the valuations, we look at things and say, you're still buying a portfolio of really good quality alumina and aluminium refineries, etc., at well below replacement cost, at a time where we think China probably are likely to move out of the market a little bit as pollution, etc., become issues. They are not a logical market to be turning bauxite with energy into alumina and aluminium. So the longer term prospects, it's been a really rotten decade or so for that commodity, but demand is still pretty good, and we think on balance those stocks are that sort of
Okay,
stock's
you want to
still
land
cheap.
on one? 3PL, you're happy to...
Okay, we'll go with 3PL.
3PL, terrific. When Steve, I rang him this morning and said, have you got your stock? He said, oh, give me a bit of time. I said, well, just come in and surprise us all. So Steve, in the last 2.5 hours, have you found a stock that you can...
That pretty much sums it up, Matt. I've had to scrummage around and see if I can bring something along. Look, I want to caveat this first. I'm going to talk about our largest holding. The price has run up a long way, and we are likely to be reweighting that if the share price continues to run up. So I don't want people sitting there saying Steve spruiked that stock and then he turned around and sold it the next day. So that is the caveat. But our largest holding is Macmahon, and this has been an absolute woeful stock for a very long time. It's about 10 years now, and I think if you added up the cumulative decade there, you'd have a fairly significant
cigarette butt where you
loss.
burnt your fingers. Yep.
We've done quite well out of it. We managed to buy it at the right time, and I would say we don't have a great edge in finding better than anticipated management teams. Everyone wants to buy a great management team. The challenge is to buy one for less than the market is valuing it at. We've lucked into a couple that have worked out better than we thought or anyone thought, and the first of those was ServiceStream. Ended up with a great management team that nobody knew were great at the time. I think we've found one here in the new CEO of Macmahon, Mick Finnegan. He used to work at Leighton. He won a couple of Leighton's contracts recently that have come across to Macmahon, and they've got a really nice long order book, which is very rare in the mining services space. He's the right guy, I think, to earn some margins out of this business and grow it sensibly. It's going to be really interesting to watch this mining space this time around. Are they going to learn from the mistakes last time around? Is there going to be that ridiculous capital spend again? We haven't seen any signs of it yet, and I think the services space is behind the actual mining space. I think a lot of the operational issues you're seeing at a place like South 32, where they haven't spent a cent for 5 years, I think there's a bit of catch-up there in terms of spend. So not just Macmahon, but that wider services space, I think there's a few opportunities there.
Are we buying Macmahon or selling it? We're
Buying.
it.
But Steve has made it clear that he's got
that he might sell it.
His position has become large.
I've just got to get this right.
But he still thinks it's going up.
I haven't got a pen on me. Matthew, borrow your pen for a second.
The disclaimer's there. So James, have you got all the stocks?
We've got Platinum, 3P, and Short Macmahon.
No.
Long.
No.
Long. There's no shorts up here. There's no shorts.
I will guarantee
Sorry, I threw you off your
everyone
game.
An important position for us.
Yeah, that's right.
There you go.
Okay, so now it's time for questions. Have we got our first question that will appear? Black Swan. I don't think that's a stock. Is there something lurking out there, particularly with volatility so low as Vimal's comments? Ben, do you want to have a go at that? You like black swans?
No, I hate them. As a rule,
I know Steve likes black swans. He's waiting for one.
look, I would point to, and I don't think it's an immediate black swan, but it's in the distance, and that potentially is how quickly. And I don't often talk to geopolitical events, but I am somewhat anxious about how quickly or slowly North Korea becomes a major issue that unsettles markets. North Korea looks like Trump almost can't back down. He's got a number of attack dogs within his ministry that want to get on with things there, and I just figure that could very easily. And as I said, I rarely hold out geopolitical elements as being something we should look out for, but I think that'd be one black swan that could unsettle equity markets.
Okay, geopolitical. Okay, next question. Where do you think is the best place to find income in today's markets? Martin, that sounds like you. You don't mind finding income that represents value normally?
Yeah, well, as Steve said, the good thing about the Australian market is we tend to pay higher dividend yields than everyone, and you get a lot of your return through dividend yield. The banks obviously have traditionally been where it is, but our view would be that the Rios of the world will pay, you'll get pretty good income out of them, and they're less geared, and they've got a ton of franking credits, so they're still, despite being volatile, I look at those things and you say, I can't see why they're not really reasonably safe income stocks. In the end, dividends are just paid out of profits. You don't want to make it too complicated. You think the fact that there are a lot of companies, particularly in the more defensive end, that are paying unsustainable amounts out of their profits and don't pay off any debt ever.
So there's another question that leads on from that. Australian companies pay high dividends compared to the rest of the world. We've got a very enhanced tax structure to encourage to do that. Does that come back and bite us on the bum because there just hasn't been enough reinvestment in a whole bunch of sectors? Does that worry you? Or is it good for
Yeah.
allocation of capital? You restrain your capital and you've got to allocate it more wisely?
Yeah, well, it's hard to find. I mean, the obvious things that have been starved of capital are things like infrastructure, and that's around the world. Whereas the resources and banks, you could hardly say that resources haven't invested enough in their asset base. That's been their demise, investing too much. So I don't think there's a massive shortage of reinvestment. The question on things like property, though, is that it's been very hard to separate how much the asset is, because buildings depreciate. And I always find it amusing in real estate that people believe that as a building gets older and older, its value should rise and rise. You don't think about a manufacturing plant like that.
No.
And real estate and things like that, there's no depreciation or anything going through any of those accounts.
And they've got to recapitalise everything at lower and lower discount rates. But just a quick point on this. This is, I think, the most dangerous theme in the Australian market, and Australia's SMSF investors are obsessed with income, and the financial industry will sell you whatever you are obsessed with. So be very, very careful with it. If you need some money to live off every year, have that bit of your portfolio in cash for the next 3 or 5 years and take some cash out of the bank and live off it. You don't need to generate the income from your equities portfolio to live off. And it's great, in the right environment and the right prices, buy some good, reliable stocks that are going to pay you a healthy income.
Where is that, though?
I don't think it exists in this market today because people are so obsessed with it and prices are so high. You're better off buying some more cyclical businesses, maybe some ones that are reinvesting their income at high rates of return, and you'll get your returns out of capital growth, and sell a few of your shares every year if you need to buy dinner every week.
Okay.
That's why I reckon the Rios of the world are better, because people don't buy them for income. Yet there's absolutely no reason that just because you get it less smoothly doesn't make it less valuable.
Yep, sure. Okay, next question. Last year there was a lot of railing about property, yet despite since rising no comments today, have we reached capitulation among bears? So I would think, Ben, this is property in general is expensive, but leading the cry and the discussion has been residential property, which a lot of us are exposed to. Expensive, yes.
Peaked, yes.
Why has the conversation died a little? And are you worried about residential real estate prices in Australia affecting not only that market but others?
Oh, look, short term, I think property prices remain extended. We're still going to hear sporadic updates of record clearance rates and crazy prices being bid for signature properties. I think that continues for some time. I think property remains generally well supported for as long as there's international interest in property. What I do sense, what will finish this property market off, is what we saw back in the late 80s when the Japanese, who were the big drivers of Australian property valuations, and they were buying sugarcane plantations in North Queensland. They bought major hotel assets here in Sydney, golf courses. They seemed unstoppable. It was the Japanese capital inflow that drove it higher. This time around, it appears that it's Chinese inflow, capital inflow, that's driven a lot of the property advance. And I think it'll take a crisis back home, as it did in Japan back in the 80s, to withdraw, and capital gets withdrawn, drained from the market, and repatriated back to the host country. So I think that is what will ultimately transpire, and that's what will cool off the Australian property market. But I don't think it's happening anytime soon.
Okay.
So I think property prices remain well pinned, well supported in the short to medium term.
We'll stick with this question, Martin. Yields 2 to 3% in the big cities. As we said before, all asset classes are expensive. It's not like anything's too cheap. With interest rates, bond yields so low, that can be justified. Residential property, expensive, and do you worry about it?
Residential is certainly way more expensive than commercial, and like it or not, no one in Australia wants to believe that things are silly, but the simple issue of sustainability, most things, if you like, 2% yields, you got a negative carry. There's nothing much in the stock market that even vaguely resembles those valuations. So we'd say pretty clearly a lot of property investment is for speculative capital gain. That's dangerous. It's gone on way longer than anyone anticipated, but it's not going to go on forever. And the simple issues on the supply-demand arguments on property and things like that, to me, are a bit spurious. I can't quite see why one of the biggest countries in the world with 25 million people suddenly has the land scarcity.
Yeah, we've done that well, haven't we?
Yeah. Yet Manhattan doesn't seem to have that issue.
Let's go to the second derivative. Obviously, a big part of our index is banks. And sticking with you, Martin, they're exposed to that market, as we know. Foreign investors, you hear it all the time, short the Aussie banks, the housing collapse coming. Does that worry you?
I think it worries everyone that we've let the situation get to where it is. Unfortunately, the problem with the importance of banks in the economy is that you almost can't let them. The fact is, if things get dire, retail and all the things that are closer to the consumer are in a lot more trouble than banks. Everyone else goes broke first. And that principle says that we've allowed massive gearing, APRA, etc., trying to keep things under control. They're all steps in the right direction, the whole unquestionably sound type stuff. But to me, it's like bad debts have to increase. We can't stay this low forever, and we are going to have problems in the future. That's the history of banking. The arguments, though, of saying, are they crazily valued versus everything else? It's actually hard to make a coherent argument that they are.
Okay, Steve, you get to have a comment. So in 5 years' time, we sit here and all our house prices are down 25%. Is that realistic, or is it just tail off and it becomes an asset that doesn't move in price for a very long time?
I don't have the faintest idea. I mean, it's quite clearly possible. I think people's capacity to pay is what's driving prices, and we've had interest rates come down so far that people can pay 2 and 3 times the price for the house with the same amount of servicing costs that they were paying 10 years ago. So it's that capacity to pay that has allowed people to pay crazy prices, and if it diminishes because interest rates go up, or because banks tighten lending standards, or because there's unemployment and people can't afford to service those mortgages, then I think it's perfectly feasible that house prices could come down 25%. I think that's a really good point that Martin made, though. Even if, let's say we muddle through this and for 20 years, house prices don't go anywhere. Just the percentage of our economy that is now devoted to servicing mortgages, that's really something to think about, is how does the rest of the economy grow and thrive in a world where interest rates are highly unlikely to go down from here, could go up, and that means more of our income going to servicing those mortgages. So it's another risk management thing for us. I sit there and I look at the portfolio and I think, well, if that happens, what's it going to mean for us? And let's make sure we can survive it.
All right, terrific. I think that taps us out on time. We'd like to do a few more questions, but we've run past 5 o'clock, which was our timeline. I'd like to say thanks to Ben for turning up 3 in a row. Well done, Ben. Steve, thank you very much for coming in. And Martin, can everyone give them a round of applause? And thank you very much for your time, guys. Very much appreciated.